Whether you live in the UK, invest in it, or simply watch global markets, understanding the UK economy is essential. It influences global interest rates, real estate trends, and currency flows. But beneath its polished reputation lies rising debt, housing pressure, and silent risks most people miss. In this video, we're unpacking 10 financial truths about the UK economy that every investor, analyst, and money-minded viewer needs to know, because what happens here doesn't stay here. Let's break it down. Number 1. 80% of the UK economy comes from services. The UK produces over $2.9 trillion in goods and services every year. But here's the shocker. Nearly 80% of that comes from services. Banking, finance, insurance, and tech. Manufacturing, less than a fifth. If the service sector slows down, the entire economy risks stalling. And with global tech disruptions, that's more than just a possibility. Number 2. The UK imports far more than it exports. Every year, the UK buys far more than it sells. Roughly $60 billion more. That's a massive trade deficit. Services help soften the blow, but they don't close the gap. So how does the UK sustain that imbalance? The answer lies in global trust in its currency and financial system. Number 3. The pound remains one of the world's strongest currencies. Despite political shocks and economic strain, the UK pound still trades strong. This strength is no accident. It's backed by high interest rates, a reliable central bank, and deep, liquid capital markets that attract global investors. The pound is viewed as a stable, trusted currency, especially during times of uncertainty. But like all trust-based systems, that stability only holds as long as confidence does. If you're still watching, it's because you want to understand what really moves markets, and that's exactly what we break down here. Hit subscribe, turn on notifications, and let's keep going. Number 4. Economic output is concentrated in the south. London and the southeast dominate economic output, while other regions lag far behind. Investment, infrastructure, and job opportunities are uneven. This split isn't just social, it's financial. It affects everything from house prices to labor mobility and consumer spending. Number 5. Higher corporate taxes could shift investment decisions. The UK recently raised its corporate tax rate from 19% to 25% for high-earning companies. That triggered concerns about losing competitive edge in a global market. Some multinationals are already rethinking where they book profits. The UK now faces a tough balance. Stay attractive to business or fund growing public costs. Number 6. The UK's debt now equals its entire economy. The UK owes nearly $2.9 trillion. That means 100% of its GDP. Some say it's sustainable. Others call it dangerous. Either way, one fact remains. As interest rates rise, so does the cost of simply carrying that debt. And taxpayers feel that pressure first. Number 7. Rising pension costs are straining the UK budget. The UK's aging population means rising pension obligations, both public and private. Government spending on pensions already exceeds $150 billion annually. As interest rates fluctuate and life expectancy increases, the cost of meeting these promises grows. Without structural reform or higher contributions, the burden on future taxpayers will continue to rise. Number 8. Homeowners face soaring mortgage pressure. UK homeowners carry over $2.2 trillion in mortgage debt. That's nearly 3/4 the size of the entire economy. As interest rates rise, those payments get heavier, turning what once felt manageable into financial strain. Yet people continue buying, seeing ownership as more stable than renting. But with affordability sinking and credit conditions tightening, even that belief is starting to crack. Number 9. Rents are rising faster than incomes. The average UK home costs about $367,000, too steep for many, especially first-time buyers. As a result, over 4.6 million households now rent privately. But rent offers little relief. Average private rents in the UK rose by over 9% last year alone, with some areas like London seeing double-digit increases. This surge is driven by high demand, low housing stock, and landlords passing on mortgage and tax costs. Whether you rent or own, housing is becoming a bigger financial burden, and incomes aren't keeping pace. Number 10. Brexit is reshaping UK trade and growth strategy. Brexit reshaped the UK's trading identity, and the work is still unfolding. The UK is actively pursuing new trade agreements with Asia, negotiating with the US, and recalibrating its global economic partnerships. These deals carry real potential to boost exports and rewire long-term growth. But until they're finalized and their impacts fully felt, uncertainty lingers. Not because the UK isn't strong, but because it's transitioning. Even powerful economies experience turbulence during change. And the world is watching how the UK navigates this next chapter. So what does it all add up to? The UK is one of the world's largest economies, anchored by deep financial markets, a globally trusted currency, and service sector dominance. Its strengths are clear. It attracts global capital, issues debt in its own currency, and remains a hub for international trade and investment. But that strength comes with friction. Regional inequality, rising debt burdens, pension pressures, and unaffordable housing are building economic tension. What keeps the system running is confidence. In the pound, in the Bank of England, in the UK's institutions. But confidence isn't static. It's earned and can be lost. As Brexit-era reforms evolve and global conditions shift, the UK stands at a crossroads. For serious investors and financial thinkers, understanding these undercurrents isn't optional. It's how you stay ahead of what's next. If you're still here, you're not just watching finance content, you're thinking like an analyst. Tap like, hit subscribe, and turn on notifications to stay ahead of what moves markets, money, and your next decision. This is the Money Manual. See you in the next video.